Welcome back to Market Signal. This is where we discuss the signals and break down what the market is really telling us. Today, I want to focus on one number that is driving almost everything we are seeing right now in the market. And that number is the 10-year Treasury yield, which has recently pushed up over the 4.4% mark again. Because when you look at everything that's happening across the market right now, tech selling off, AI stocks pulling back, volatility picking up again, it all ties back to that one number and the increase in the rates that we're seeing. And the key point is this. This is not a fundamental breakdown. This is a valuation reset driven by rates. Let's dive in and talk about the data, take a look at the results and the impact it's having on companies. But if you haven't done it already, hit like, hit subscribe to the channel. I appreciate you guys being here. All right, let's start with the data. Let's start with the numbers. The fact is that the 10-year Treasury yield has moved roughly from 3.9% that we saw earlier, like right at the beginning of March, towards the end of February, to now over the 4.4% again when it closed on Friday. That's a 50 basis point move, or roughly about a 13% increase in a risk-free rate overall. Let's take a look at the number and how it's been trending. You can see on your screen, 10-year Treasury yield has jumped to a 4.43%, up 4.43, up 0.5% at the close on market. And you can see where it's trending. If we go back to right here, you can see on your screen, towards the end of February, we're at a 3.9. If you look where we are closing in at the end of March, that is a 4.43% overall. That is a significant jump in risk-free money. And what we're seeing right now in the market is capital is rotating to these safe havens, into the Treasury yields overall. And that is having a significant impact. When you see you saw that significant growth that we saw in the month of March. This is the highest it's been, I think, since August of 2025. And at the same time, we're seeing oil surge by 30-40% from recent lows, pushing inflation expectations higher. And when inflation expectations rise, like we're seeing, rates follow. And when you look at how it's impacting the market, we've seen the NASDAQ actually drop roughly, it's down 12% from its recent highs this year. When it was at almost 24,000, now we're closing just under 21,000 for the NASDAQ. So down about 12%. We're seeing high growth AI names having pulled back 15 to 25% in many cases in that same time frame. We're seeing volatility across many significant tech names. If I just pull up this on your screen, you can see how we closed the day on Friday. Just look at the change in many of the tech names we saw. Guys, this is not random. This is what it looks like when the market is repricing risk overall. So now let's take a look at how those rates have been crushing tech. We can take a look at how it's impacting actual companies right now. Because when the 10-year Treasury yield increases or rises like we're seeing, it increases the discount rate used to value future earnings for tech companies. And for long duration assets like tech and like many of the big names in tech, it has a direct impact overall in the company. Take Nvidia, for example. Let's jump over and take a look at Nvidia. And you can see on your screen right here that Nvidia, if you take a look at how it's performed in the last week, in the last month, down 3%, we know last week, down almost 5.5% in the last month, or the month of March, we'll call it. Reuters also reported that Nvidia's forward PE has already dropped from 34.6 to 24.5x. And more recently, Barron's has noted that it compressed even further to around 19.7 forward earnings. That's a massive multiple contraction without a collapse in demand for this company. You can see the impact it's having in them. Now let's take a look at Microsoft overall. If we jump over to Microsoft, you can see on the screen Microsoft's earnings. If you just look below, or their results or returns this week, were down 6.5%. But look at the 1 month, over 9%. And guys, look at the 3-month return for Microsoft, 26, almost 27%. They are on pace for their worst quarter since 2008. And when we jump over to take a look at another big tech name, which is Meta, we could see that Meta, if you look just at the 1 week, Meta was down by 11.4% this past week. It wiped out 172 billion in market cap for Meta. And if you look at how they're trending for the month of March, almost 19% down overall. So you can see the impact that the rates are having on these high-tech companies. So across semis, software, platforms, we are seeing the same pattern. Businesses are still strong, but investors are paying less for that growth. That is the direct impact of higher rates. Now, if we take it a step further, because this isn't just about selling, this is about rotation, and we can actually measure that rotation. Let's take a look at the sectors and see how the sectors were performing. Let me jump over to that, pull that up on the screen for you. And you can see right now on your screen, we're looking across all of the sector performance for the day, for the month, for the 3 months. I want to draw your attention to a few here. So if you just take a look at how capital is rotating overall, you can see the energy sector, the top line there was up, almost 2%, 1.87 on Friday. But in the last month, over 14% growth. Now let's take a look, compare that to tech as well as communication services. And if you drive down to tech, 2 below the middle line that's grayed out, which is the S&P 500 overall, you can see that tech is underperforming the S&P 500. It's down by 2.02% on the day on Friday, but in the month, it's down almost 8.5%. And also one line right below tech, you can see communication services down by 2.25%, down over 10% in the last month. And if we jump over and take a look how that compares to crude, we can see that overall in the 1 month, Brent crude is up over 51%. You can see in the last 5 days or the week, it's up 6%. So that is a significant difference. If we just compare the rates that we're seeing in the sectors for tech and communication services, seeing that money rotate into energy and other sectors, and it's being driven by the Brent oil prices. So when we zoom out, you see energy is up almost 15% over the last month. Tech is on pace for its 5th straight monthly decline. This is the longest streak since 2002. And when you get into the fund flows, the sector funds show that 2.9 billion in outflows with tech among the hardest sector hit. Treasury funds saw over $9 billion of inflows, the largest since May of 2024. Global energy funds pulled in 2.1 billion in March. That's near a 12-year high for energy funds. So this is not passive. Capital is actively leaving tech and moving into energy and safety. This is a major shift we're seeing in the market right now. It's a shift into positioning overall. And if we take a look at Micron, it's another great example, because this is where things get interesting, because even within the semiconductors, not everything is behaving the same way. Micron is a great example of that. We know from the fundamentals, we've talked about it in this channel. Micron had almost 24 billion in revenue in Q2. It's 75% gross margins. They had over 14 billion in net income, over $12 in earnings per share, and almost 7 billion in free cash flow. And the company is now planning over 25 billion in capex to meet the AI-driven demand. This is not a weak business at all for Micron. We've talked about this on the channel. You guys know how strong I believe in the memory sector, how strong I believe in Micron. The fundamentals bear that out as well, or prove that. Now, if you look at the stock, it's down, I think, 23% from its recent highs. It's trading at a 4.5 multiple right now with the forward earnings. It is the cheapest stock in the S&P 500 on that metric. And at the same time, many are saying their earnings per share estimates have now risen to almost $80 for the year. So you have record margins, explosive demand, rising earnings, and the stock trading at 4.5 times earnings. That is a signal that we can't ignore in the market. The market has already repriced Micron aggressively. And part of that came from the AI efficiency narrative when Google introduced TurboQuant. Memory stocks dropped over 6% in a day on fears of lower demand. So when the broader tech sell-off hit, Micron didn't reprice as much because it already had repriced The market is telling you a signal there. There is tremendous fundamentals for Micron. And if you remember the video I put out the other day talking about some of the moves that happened this weekend, that again, it gave me more confidence in this sector and these companies overall based on the demand in the marketplace. So when you connect all of these dots together in the picture, it becomes very clear. This sell-off is not about fundamentals. It's about higher rates, tighter financial conditions, and capital rotation. And more importantly, the AI trade is no longer moving as one. We've entered a phase where valuation matters, positioning matters, and selectivity matters. But now I want to give you one bonus signal before I leave the video and close out this video. I want to give you a bonus signal or stock that I'm looking at, and I'm looking to add about 40 to 50 shares when the market opens. And that stock is Supermicro Computer. The stock has dropped. Here, let me show you overall, guys. Let me pull it up. And I just want to show you why and talk about it a little bit of why I'm looking. If you look at the stock overall, you can see on your screen, it closed at 21.97 on Friday. It's down 32% in a month. And if you look at the 6-month time frame, it's down 52% overall. So you can see that clearly on your screen. Now, let me give you a reason why I'm looking to add for Supermicro. It's because we know the stock is driven down by 50% in 6 months from its prior high, 30% the last month, driven by the legal and regulatory concerns that are surrounding the stock. But the fundamentals for Supermicro tell a different story. Quarterly revenue, it was around $12 billion. Growth rates exceeded 100% year over year. And they have deep exposure to AI server demand. And at a valuation right now of roughly 10 to 12x forward earnings, if you compare that to other benchmarks that are trading around 20 or 30x overall, you have a clear disconnect in the market. But I will be clear and transparent, the risks are real with Supermicro. There's regulatory scrutiny, governance concerns, potential customer hesitation, and we've seen this company go through these risks in the past as well. But in my opinion, and do your own research, make sure it's a fit for you, I feel that Supermicro may be undervalued based on the fundamentals. But the discount exists for a reason. It's because of the risks that we mentioned. The market is pricing in risk right now for Supermicro. They're not ignoring the opportunity. So the question that you have to ask yourself, that I have as well, and I've decided that I'm going to move in and acquire more shares in Supermicro. The question is whether the risk is worth it to you. In my opinion, for me, it is. I think this company is significantly under trading where its value is in the market right now. To me, I wanted to share that. That's the bonus signal for this video over. So in closing, the takeaway is simple, but it is powerful. I hope you agree from watching the video. The sell-off is not random that we're seeing in the market right now. It is being driven by one key variable, rates. And until that changes, pressure on high multiple tech is likely to continue. But within that pressure, the signals are starting to emerge. And that's where the opportunity is overall for us as investors. So good luck navigating the signals this week. I'll be watching as well. And make sure you tune back into the channel and make sure you watch the daily updates I'll drop each and every day this week. Have a great week overall, guys. Hope you enjoyed the video.